Hi everyone, my name is Junhong. My group members consist of Subhashini, Ziyi, and Ziting. Today we will discuss about mutual funds. Mutual fund pools the capital of many individual investors and invests in a set portfolio. Steve decided to invest. He wants a balanced portfolio. The portfolio was broken down into 50% of stock, 30% of bond, and 20% of cash. However, Steve only has $50 to invest. This means that he only has $25 for stock and even less for cash. There is a limitation for previous option, but not mutual fund. Mutual fund allows Steve to pool his money with other investors in the portfolio. By purchasing unit in fund, Steve can get the exposure he wants. Utilizing the strength in numbers, mutual funds allow the individual investors to allocate their dollars to ways they couldn't have otherwise. Let's talk about the history of mutual fund. The mutual fund was born from a financial crisis that struck Europe in the early 1770s. The British East India Company had borrowed heavily during the preceding boom years to support its ambitious colonial interests, particularly in North America, where unrest would culminate in revolution in first few years. Due to declining revenue, the East India Company sought a bailout in 1772 from the already stressed British treasury. It was originally too big to fail operation, and the repercussions were felt across the continent and indeed around the world. At the same time, the Dutch were facing their own challenges, expanding and exploring like British and taking copycat risks in a pattern that has drawn parallels to the banking crisis of 2008. Against this backdrop, a Dutch merchant, Adrian van Katwijk, had foresight to pool money from a number of subscribers to form an investment trust, the world's first mutual fund, in 1774. Financial risk to the many small investors was spread by diversifying across the number of European countries and the American colonies, where investment were backed by income from plantations and early version of today mortgage-backed securities. Subscription to the closed-end fund, which Van Katwijk called Ingrid Magma, 90 trade strength, was available to play till all 2,000 units were purchased. Fund prospectus require an annual accounting, which investor could view when requested. Two subsequent funds set up in the Netherlands placed the emphasis on diversification to reduce risk, escalating their appeal even smaller investors with minimum. Van Katwijk funds survived until 1824, but the liquid greatest is still a form of personal investing more than 2 centuries later, with an estimated $7.86 trillion in global assets in July 2013. In Canada alone, mutual funds represent $1.43 trillion. The early mutual funds spread were of the closed-end variety, issuing a fixed number of shares. They spread from the Netherlands to England and France before heading to the US in the 1890s. The first modern-day mutual fund, Massachusetts Investor Trust, was created on March 21, 1924. It was the first mutual fund with an open-end capitalization, allowing for the continuous issue and redemption of shares by the investment company. After just 1 year, the fund grew to $392,000 in assets from $50,000. The fund went public in 1928 and eventually became known as MFS Investment Management.
The very first step before starting to invest in mutual funds is that you have to first decide which mutual fund are you buying. Next, it is important to always remember to pick a diversified portfolio of funds so that you will have a balanced portfolio that can thrive under a wider range of market conditions. After that, you will have to register online for a mutual fund account, and only then you can start to invest in mutual funds. Next, you will have to deposit the initial investment on the chosen mutual fund company, but always make sure not to pay an upfront sales loan on a mutual fund purchase, as this will simply divert a percentage of your initial investment into broker's wallet. Lastly, once you had started to invest, you need to keep on monitoring your portfolio to make sure that everything continues to run smoothly. You can always check for the updates from the website of the mutual fund company. Mutual fund is a great way to invest without a huge amount of effort, but always remember to gather all information needed regarding the company before making a decision to invest in the company to avoid any huge losses in the future.
Next, we are going to discuss about the policies and regulations of mutual funds. According to the exposure limit, the value of a fund's investments in unlisted securities must not exceed 10% of the fund's net asset value.
According to the investment spread limit, the value of funds' investments in transferable securities and money market instruments issued by any single issuer must not exceed 15% of funds' NAV. The value of a fund's placement in deposits with any single institution must not exceed 20% of the fund's NAV. Meanwhile, the value of funds' investments in units or shares of any collective investment scheme must not exceed 20% of the fund's NAV. The value of a fund's investments in transferable securities and money market instruments issued by any group of companies must not exceed 20% of the fund's NAV. For investments in derivatives, the exposure to the underlying assets must not exceed the investment spread limits stipulated. The value of funds' OTC derivative transaction with any single counterparty must not exceed 10% of funds' NAV. Next, in ordinary shares, investments issued by single issuer must not exceed 10% of funds' NAV. The aggregate value of a fund's investments in transferable securities, money market instruments, deposits, OTC derivatives and structured products issued must not exceed 25% of the fund's NAV. Hi Miss Andrea. How much is the minimum value of mutual funds investment? Hey, Lisa. The minimum value that can be invested in mutual funds is Ringgit Malaysia 1,000. Next, we are going to have a look at the mutual fund in Malaysia's current market. Let's have a look at the Malaysia's top mutual funds. The following graph shows the performance of Kenanga Growth Fund. This is the performance analysis graph of East Spring Investment Small Cap Fund. The following graph shows the performance of RHB OSK Small Treasure. I have a doubt. Which mutual fund is better? From the table and chart above, none of the more than 10-year-old funds actually loses money. They all have positive returns after 10 years. So, the longer term we invest, the less chance we lose money based on the current mutual fund market.
There are 7 types of risk when it comes to mutual fund, which are market risk, credit risk, interest rate risk, concentration risk, liquidity risk, country risk, and currency risk. Market risk is a systematic risk which may result in losses for any investor due to a poor performance of the market. One of the examples of the factors which affect the market is inflation. It's hard to predict and impossible to avoid. The only thing which the investor can do is wait for the storm to come. Credit risk basically means that the issuer is unable to pay what was promised as interest. This risk can be minimized by making sure the fund is invested in higher grade investment security. Interest rate changes depending upon the credit available with lenders and the demand from borrowers. Increase in the interest rate may result in a reduction of the price of securities. Concentration risk comes in when a mutual fund invests too large proportion of its money in one sector. Concentrating in one sector is very risky. Profits will be huge if lucky, but losses will be more as well. The best way to minimize the risk by diversifying your portfolio. Liquidity risk occurs when a seller is unable to find a buyer for the security. The security may be forced to sell at a lower price or forgo an investment opportunity due to liquidity constraints. It can be avoided by having a diverse portfolio and making fund selection diligently. Country risk occurs when the value of a foreign investment declines because of political changes or instability in the country where the investment were issued. These are the examples of events that country risk would include. Currency risk arises when foreign currency declines against the local currency, the investment will lose value. It's only applicable to funds that invest in investments that involve denomination by other currencies. Next, I'm going to introduce about mutual fund value. The net asset value of a mutual fund is the price at which units of a mutual fund are bought or sold on a specific date. It is the market value of the fund after deducting its liabilities, then divided by the total number of units. This is the formula of NAV, which is equal to assets minus debt and divided by the number of shares. Assets are the summation of the market value of mutual fund investment, receivables, and accrued income, as debts are liabilities plus accrued expenses. For example, a client has 5 million shares and these are all the details that he has. By applying this formula, the net asset value will be $19.21. Net asset value per share is an expression for net asset value that represents the value per share of a mutual fund. It's calculated by dividing the NAV by the number of shares outstanding.